Basically, the policy rate is too high right now. It doesn't seem like we're going to go back to the era of 2009 to 2019, where you had exceptionally low interest rates worldwide, negative nominal rates worldwide. The pandemic was big enough to knock us out of that regime and back into something that's more consistent with the 1990s or the early 2000s.
We're going to evaluate the recent Fed decision to cut by 50 basis points. Will this move reignite inflation? What will it do to long-run economic growth? And what is the outlook for the unemployment rate and the health of the labor market overall? Will the unemployment rate continue to tick up from already very high levels compared to a year ago? Jim Bullard is here to discuss all this and more. Jim is the former president and CEO of the St. Louis Fed, having served with the Federal Reserve from 2008 to 2023. He is currently the dean of the Purdue University Daniels School of Business, and Jim is here to answer all those questions, give us his outlook on the economy, talk about the risks that the economy faces, and give us an inside scoop on how decisions at the FOMC are made. Jim, an absolute honor to host you today. Welcome to the show.
Great to be here, and thanks for having me on the show.
We're going to discuss your macroeconomic outlook. And like I told you offline, I polled my audience about what I could ask you. And many of them were interested in knowing about how the Federal Reserve works and makes decisions in monetary policy projections. So we'll discuss that as well. Let's start by talking about your outlook. If you were still at the Fed today and you were still part of the committee that makes the summary of economic projections, what would you rate in terms of your outlook on inflation and growth? In other words, how would you compare your assessment to the latest summary of economic projections? I can pull that up here, actually. If you take a look at my screen, we have here change in real GDP, 2%, 2%, 2%, and basically 2%, the long run at 1.8%. PCE inflation cooling off is a projection. Do you agree with this latest series of projections, Jim?
So I would say that for 2024, the 2.0 that's in the upper left corner there, that sounds a little low to me. Second quarter GDP growth was 3% on a revised basis, and the current quarter looks pretty good. So I'm a little more bullish on the economy. I don't know what I would have put down there. And then I would have had it slowing to 2%, but staying at 2% in the longer run, because I'm a little more optimistic about the U.S. economy. So that I think that number, slightly higher profile than what the committee would have had. And then on the inflation, PCE inflation, I wouldn't have any quibble over the 2.3 there, and I would have it going to 2% over the next 2 years. So I think that's about right. The highest number there is the 2.6 on core PCE inflation, and that sounds about right to me as well for 2024. So not too much different probably from what the committee has, but I'm a little more bullish on the real side.
Fed funds rate projection. Before we ask you about that, actually, a lot of people on my show have argued about whether or not the dot plots are a useful tool. What is your reaction to the consensus view that the dot plots is inconsistent in terms of its accuracy?
Yeah, I mean, if you follow me, at points in time, I've thought about dropping out of the dot plot altogether because it does create confusion sometimes. It is a way to communicate the outlook for the committee, but various quirks in it have not been fixed, and I don't know if they will be fixed, so it's kind of questionable. One thing about the dot plot is that the horizon shortens up as you go through the year. And so the September meeting, you're doing a different exercise than you are at the January meeting.
Mm-hmm.
The January meeting, you have a whole year ahead of you, so you're forecasting 1 year in advance. But at the September meeting, you only have 2 meetings left. So you're basically saying exactly what you think you're going to do at the next 2 meetings. So I think that's caused problems for the committee. at times, and also, I think it's hard to communicate that the dot plot is not a coordinated forecast exercise. So it's not clear which inflation forecast goes with which GDP forecast. And so the dots are kind of a scramble of various outlooks for the different variables.
Before we continue with the interview, I'm going to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. And presumably, different members of the Federal Reserve and different governors have different outlooks on the economy and different opinions on what the Federal Reserve should do with their monetary policy. So ultimately, at every single meeting, how is the decision to keep rates and change, raise or lower rates? How is that decided? Can you just walk us through in layman terms the general process here?
Yeah, I think the best thing to keep in mind is that it's a large meeting with a lot of pressure on it. So you have 19 members when the committee's at full strength. Even to ask a single question and then go around and get everybody's opinion on that particular question, that takes about 90 minutes all by itself. So those are called go-arounds, and the chair has to be careful about what gets asked in a go-around because it takes so long just to execute. We get reports from staff, which are excellent. We get sometimes special topics, special research topics are discussed, and so it's a long meeting. It's a day and a half meeting, and so I would just remind everybody about the size and scope of the meeting, and the chair has to make sure that for most meetings, you want to walk in basically knowing what's going to happen. Maybe not exactly what's going to happen, but pretty close, because it's very hard to just come in without a good idea of what's going to happen and then get to a good conclusion at the end of the meeting. And when the FOMC gets into trouble, it's usually because there's volatility right ahead of the meeting, which is scrambling up the plans for what otherwise would have been done. And so that's another thing to keep in mind. I can give you some examples of that, but most meetings come off without too much of a hitch, and there's been plenty of prep in the week running up to the meeting.
And how much power or influence ultimately does the chair have on making the final decision?
Yeah, I've always felt that the chair's job was to stay in the middle of the committee and make sure that you're in touch with the members' views, because the membership takes the role very seriously, and they have very sharp opinions and good perspectives, I would say, on the economy. So if the committee's shading one way or shading the other way, then the chair tries to stay in the middle of that so that he can fashion a good compromise that will encompass the views of the committee. So I don't really think it's like the Greenspan days, which is he was more an imperial chair, where he's trying to suggest what the committee should do. Instead, they're trying to solicit opinions and try to stay in the middle of those views. So basically, what happened, Bernanke came in, former chair Ben Bernanke came in and democratized the process quite a bit from what Greenspan had, and that has led to Janet Yellen copied that, and then Jay Powell copied that.
Can you give us some color on the types of data or data sources that the Fed relies on for both inflation and unemployment. One of the criticisms I've heard, Jim, from the economists that I've interviewed and some analysts is that the CPI and to some extent the unemployment rate, they are lagging indicators. And so the Fed's always behind the curve. If they look at BLS data from a month ago, are there any more, I would say, real-time data sources that the Fed could use?
Yeah, it'd be wrong to say that the Fed doesn't look at all the data. Basically anything that might be relevant certainly gets looked at and analyzed. So the Fed is very good at considering a wide variety of data sources, including real-time data, and that feeds into much of the analysis as well. So one of the things that happened during the pandemic was that the uh, jobs reports were very negative as the onset of the pandemic came started in March and April of 2020. And at the St. Louis Fed, I was briefed on, hey, maybe we should use some real-time data, and maybe we'll get a better prediction, of what's really going on in the jobs report. And so we used weekly data from Homebase. One of our economists put together an analysis, and I was sitting through this analysis, and the Wall Street was expecting for the May jobs report was expecting minus 13 million jobs. So totally terrible. And this analysis predicted a plus 3 million. And in the briefing, I said, well, nice try, but evidently, you're way off from what Wall Street thinks. So I guess this isn't working very well. Then the jobs report actually came out. It was about plus 3 million. So you got it spot on. So after that, real-time data became very popular around the Fed, especially during the pandemic. We were trying to track things almost on a daily basis.
Okay, I want to come back and finish off the interview with some of your stories.
Okay.
But let's go back to your economic outlook for this next part. So going back to my screen now, Jim, as you can see, the Fed funds rate projection is here on this line. Well, the June projection is here, and then the latest one is basically the Fed is projecting a median rate of 3.4% by 2025. If you flip over to this tab here from the CME Fed Watch tool, you can see that the market is a little bit more aggressive in pricing in more rate cuts over the course of the next year, with the bulk of this distribution lying between 275 to 325. Why do you think the market is a little bit more dovish?
Yeah, the market probably thinks inflation is going to come back to 2% faster than what the Fed is thinking. And from a policymaker perspective, you really want to hit the 2% inflation target. But from a market perspective, you don't have that risk component that you might not hit the 2% target. So I think the Fed is being more cautious in projecting what's going to happen based on possibly stickier inflation, and the market's assuming less sticky inflation and a flatter path for the inflation profile.
Okay, and what do you think should be the correct or most accurate gauges of inflation? In other words, which metrics would you use in your model for your inflation outlook?
Yeah, the Fed's preferred measure is core PCE inflation. That's because it throws out food and energy, and it has a broader perspective on all the expenditure in the economy. So it's good in a way because that provides focus to the committee, but there are at least a dozen other possible measures of inflation. One that I like is the Dallas Fed Trim Mean. So that measure looks at the entire distribution of price change, and then lops off some of the high ones and some of the low ones each month, and then you get a measure of kind of the center of the price change distribution. I think that's probably the best way to go, but it's not too much different from the core PCE inflation.
I've talked to some economists who believe that the money supply is the core driver of inflation. And actually, if you look at a chart between the CPI on an annual percentage change basis, so inflation rate versus an annual percentage change of the M2 money stock in the US, there has seemed to be somewhat of a close relationship. Jim, how important is the money supply for ultimately driving consumer price changes?
I mean, I come from the monetarist roots, and so I'm very much a fan of the idea that money is, a key driver of inflation. I think it's hard to just point to empirical evidence on that. It's been mixed over the last 20 years, and that's why people don't talk about it as much as they would have earlier in my career. But I think you have to keep in mind ultimately that that's where inflation is coming from. It's not coming from any particular price rising or falling. We're talking about all prices rising or falling, and I've been a little bit disappointed in recent years that people don't remember that about what the nature of inflation really is.
I remember in 2022, Chair Jerome Powell held a press conference and he said, and I quote, "We need to unlearn monetarism." How would you interpret that message? Would you say that the Fed is no longer interested or prioritizing balancing or changing the balance sheet of the Federal Reserve in order to meet its mandate of controlling inflation?
No, I don't think you need to unlearn monetarism. It's got to be, there's more to it than just saying it's the rate of growth of the money stock, because you also have anticipations or expectations of the rate of growth of the money stock. So if you thought you lived in a country where the central bank was responsible today, but was going to be irresponsible tomorrow, then prices might start going up today. You wouldn't see the correlation between money and prices on that particular day, but it would be well informed because markets are anticipating some kind of bad policy coming in the future. So this interplay between the expectations and monetarism is really what the modern theories are all about, and it's not just here's how fast the money supply is growing, and therefore here's how fast inflation is going up.
Earlier, you had said that the real GDP forecast of 2% is perhaps a little bit soft for you. Why do you think that the economy will grow a little bit faster than that?
Yeah, they've got 1.8% on the long run growth rate of the economy. I would put it at 2%. I'm a little more optimistic that we're going to see technological change feed into business sector productivity and drive growth a little faster, hopefully much faster or somewhat faster in the future. I admit that you can't actually see that in the data today, but it does seem like there's a lot of great technology around that'll eventually find its way into productivity and drive growth for the U.S. economy.
So, do you think that we're heading into a soft landing into 2025?
I do, and I'd actually define where we are as pretty close to a soft landing. If you take your major variables and they're all within a half a percentage point of where you think they'll be in the long run, I would consider that, uh, basically a soft landing, considering that just 2 years ago or 2.5 years ago, we were a long ways from anything that you could think of was sensible for the U.S. economy.
Well, in 2022, the U.S. experienced 2 quarters of consecutive negative real GDP growth, but it wasn't officially declared a recession. Why not?
It wasn't corroborated by the other evidence that you would need to declare a recession. So you would need um, other things to be happening, including job growth being negative. But at the time, job growth was stunningly positive. It was really strong. So it was hard to say that that was a recession, even though output was declining. So I would put that down to some of the twists and turns of the aftermath of the pandemic, and that's why that particular measurement was odd in that period. But I don't think it was a recession.
Okay. I'd like to play for you a clip of Chair Powell answering a question about whether or not um, money will stay cheap for quite some time. Uh, Take a look at my screen here.
Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that, but honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. It's again, we only know it by its works.
The neutral rate is probably higher now than it was back then. Can you respond to that, please?
Yeah, I do think I agree with Chair Powell's statement there that it doesn't seem like we're going to go back to the era of 2009 to 2019, where you had exceptionally low interest rates worldwide, negative nominal rates worldwide. I would think of that, and I have promoted the idea that you should think of that as a regime, a low interest rate, low inflation regime. And the pandemic was big enough to knock us out of that regime and back into something that's more consistent with the 1990s or the early 2000s. And that's why I've encouraged people to look at those time periods for pricing behavior as opposed to the period between 2009 and 2019, which I think was the anomaly.
Turning now to the labor market, as you know, a few weeks ago, or actually earlier this summer, the SOM rule was triggered. The SOM rule is a rise in the U3 unemployment rate by, as you know, 50 percentage points or 0.5 percentage point, 50 basis points or more relative to the minimum of the 3-month average from the previous 12 months. Usually in the past, whenever the SOM rule has been triggered, a recession has followed. Now, Claudia Somm has gone on the record, even in my show, saying that perhaps this time the rule may be broken. If you look at the chances of a recession, it has climbed higher. If you look at the unemployment rate, it has been ticking up steadily. Are you concerned that the unemployment rate is just going to continue going up now into what is going to ultimately be a recession if it continues to worsen, Jim?
I have a different take on this. I am not too worried. And the way I would express that is that we live with a probability of recession every day. The same way we live with the probability that we'll get into a car accident or we'll get sick every day. But I don't think our probability is any higher right now than it would be in ordinary times. So in that sense, I think that we don't face any higher recession risk. Of course, now, I say, if you read the literature in macroeconomics, it says that recessions are caused by big shocks. So it says when a big shock occurs, then the unemployment rate goes up very quickly. And that could happen, but you would have to get the big shock, and we can't predict when the big shock might occur. So I think from that point of view, the SOM rule is exactly right. When a big shock hits, unemployment rate goes up very quickly, but we don't have that big shock right now. So, possibly one would occur sometime in the next few quarters, and then the unemployment rate will go up. But we don't know what that would be right now.
I attended the CFA event in 2017 where Janet Yellen was an honorary speaker, and somebody asked her what causes recessions, and she said, number one, financial imbalances, so referencing big shocks like you just said. Number two, the Fed. That's what she said. So to dovetail off of that joke.
Well, I guess what I would say about that is if you go far enough back in history, that especially pre-1995, then most of those recessions did get tagged with the Fed. So, but that's kind of a different era in monetary policy as opposed to the last 25 years or 30 years.
All right. So I think people have been wondering whether or not the Fed is behind the curve. Now, I want to show you this letter from Elizabeth Warren and two other Democratic senators on the 16th of September, 2 days before the FOMC announcement. This letter was penned by three Democratic senators, including Elizabeth Warren, in which I'll just read snippets of it. We write today to urge the Federal Reserve to cut the Fed funds rate, currently at a two-decade high of 5.3%, by 75 basis points. In fact, it may be too late. Your delays have threatened the economy and left the Fed behind the curve. And then it finishes off by saying the FOMC must cut rates by more than 25 basis points, or more than the 25 basis point cut that the Fed has already signaled. So a few things to unpack before we continue. First of all, do you agree with her assessment that the Fed, or their assessment rather, that the Fed may be too late and that they are behind the curve on feeding inflation?
Well, I would say generally speaking that the Fed has played this very, very well. Inflation was very high 15 months ago by U.S. standards, and the Fed took very aggressive action very quickly, 4 75 basis point increases in a row. And inflation, that's exactly at that point that when inflation turned around and started to come down. And then we got a lot of disinflation in 2023, less in 2024. So I think overall the policy's been very successful. I did give talks earlier this year where I said, they should be moving. They should tick the funds rate down a little bit, maybe during the spring or during the early part of the summer, but they didn't really find a moment that they could do that. And so we ended up at the September meeting, and that ended up with 50 basis points. But overall, I would say the policy's been very successful. And I think the senators would also acknowledge that the lower inflation is very good for the poorer segment of society. I think that group gets hit especially hard by inflation. They can't really do other things to adjust to the rising prices, and they're on some salary job or some hourly job, and they just get hit with the higher prices, and they suffer because of it. So I think we've done a lot to get inflation under control, and that's probably better for the lower end of the income distribution.
And I think there's been some chatter as to whether or not the Federal Reserve caved to political pressure following this release of this letter. Now, it could just be a coincidence. Maybe the FOMC already made up their mind before this was announced. But what is your general reaction to lawmakers, some economists would say, interfering with Fed policy by suggesting or urging certain policy measures that they would like?
I think there are elected representatives, and they are certainly entitled to their opinion, and they can write letters over asking, arguing one way or another for the committee. I don't think they carry a terrible amount of weight for the committee. The committee likes to just make the decision based on the facts that are available and try to, sort of play it straight, I guess I would say. So, I mean, I suppose you could have everyone in the Senate write a letter and about what they think the Fed should do. Usually they try to stay away from that, and most people are pretty happy, most elected officials are pretty happy to have the Fed working on it and not them directly.
I want to draw your attention to this letter of dissent that you wrote on March 18th, 2022. I dissented with the Federal Open Market Committee. Decision announced on March 16th to raise the target range for the Fed funds rate by 25 basis points to 50 basis points. In my view, raising the target range to 50 to 75 and implementing a plan for reducing the size of the Fed's balance sheet would have been more appropriate actions. So looking back, we have the benefit of hindsight. Would you still have written this letter?
Yeah, I thought that was a good dissent on the day. As you recall, not too long after this, the committee started to shift quite a bit. I think at the next meeting we raised by, if I recall correctly, by 50 basis points. And then at the June meeting, we raised by 75 basis points. So I think the sense of urgency, the sense that inflation process was getting away from the committee and we were losing credibility, I think that started to hit home during the spring of 2022. And then that led to a pretty dramatic policy change, but one that turned out pretty well at the end of the day.
And I think a lot of people are wondering this. And again, we have the benefit of hindsight, but is there anything the Federal Reserve could have done differently in the last 2 years that could have prevented inflation from rising up to 9%, perhaps capping at a lower rate of inflation? Do you think that maybe the Fed should have been a little bit more aggressive with raising rates?
Yeah, we should have been, and I think those that are speculating on this should remember where the country was and the world really with respect to the pandemic, because I think some of the key things we could have done was we could have not been purchasing mortgage-backed securities. It turned out that the pandemic actually helped the housing market, didn't hurt the housing market. And another thing is we could have been raising the policy rate sooner, but the vaccines were just coming on board in the spring of 2021, and I know for myself, I wanted to see if the vaccines would work or not, and the pandemic would end before we started talking about pulling back on monetary accommodation, and that meant that you couldn't do anything till the third quarter of 2021. Seems like we didn't do anything at that point, but actually we started to get more hawkish at that point, especially November of 2021, and the chair definitely took a hawkish turn at that point.
Is there a sense of urgency to cut rates by more than 25 basis points, even more than 50 basis points today? You stressed a sense of urgency to raise rates during the pandemic. What about now? Because we had high inflation back then, but what about now?
Yeah, I think that they've, basically the policy rate is too high right now, because this is even today, even after the 50 basis points, but what has happened is that they went to 5 3/8 based on a high inflation environment. And then they came to the conclusion that that was the number they wanted to be at. That's fine. And then inflation went down by their preferred measure by 200 basis points. So usually you have to take that on board and say, okay, well, we don't need to be quite as restrictive anymore because inflation isn't as high as it was before. And for various reasons, they couldn't make that adjustment until this last meeting here. But basically, this was an environment where you wanted to reduce the policy rate just based on good inflation news, not because anything's wrong with the economy, but just because inflation's lower and you don't have to be as restrictive as you were previously. And many have also pointed out, and I think this is important, the standing still while inflation is falling means the real interest rate, on a simple basis anyway, is rising. So you're actually becoming more hawkish as the inflation rate is coming down. And that's been a concern of some on the committee as well. So I think just to get down to a lower level of the policy rate, and then at that lower level, then you can try to navigate the inflation back to 2% and keep the economy on an even keel.
I have a few more questions. The first one is regarding other central banks, and then we'll finish off on one guest question, or viewer question rather. There is a divergence currently of central bank policies, as you know. So the Bank of Japan, the Bank of China, and the Bank of England all met last week. They kept rates unchanged. Do you think the Fed may be looking at what other central banks are doing to perhaps make their own policies, or vice versa? Perhaps other central banks are looking at the Fed.
No, there definitely is a lot of cross communication between central banks. I would not put it as high as coordination, but I think everyone wants to know, and I wanted to know when I was on the FOMC, what the other central banks were doing, how that was going to come back and influence the U.S. economy. So I think all these other, places like the Bank of England or People's Bank of China, they want to understand the global environment that they're operating in.
Why does it matter? Why did you want to know? Can you give us maybe just one specific example as to how another central bank's policies could influence the U.S. economy?
Well, among other things, there'd be interest rate differentials between countries that would affect exchange rates, that would affect trade flows. So there are reasons to think even real GDP in the home country would be affected by what's going on abroad and what policy is going to be abroad.
Finally, I have a question from a viewer. His name is Cassius. Please ask him to be specific about what metrics they look at to determine rate cuts, or I guess monetary policy in general. Just saying unemployment rate isn't detailed enough. I guess what the viewer is trying to say, Jim, is to what to what extent does the Fed look at direction versus absolute level, and how do they ultimately make the call that the unemployment rate is high enough or the inflation rate is low enough for a cut?
Yeah, I think this decision was probably more influenced by recent inflation news than people maybe realized. There was this earlier shift in July to say that the committee was paying, more attention to both sides of the mandate because of weak jobs numbers. But overall, I think Governor Waller's interview with CNBC on Friday made it clear that it was really the inflation numbers, at least for him, that drove him to support the 50 basis point cut. So he cited, 4 months in a row of a run rate on inflation that's actually below 2%. And he said that started to make him concerned that they were too hawkish and they needed to get down a little bit faster than what he previously thought. So I think, there are lots of subtleties about measuring inflation, and you've got rents in there, you've got different indexes of inflation and so on. But that was the story he told about why the 50 basis point move was something he could support.
Final question: what would be the dominant or one of the major risks that going back to what you said earlier about shocks? We don't know what these shocks are. We don't know what a black swan by definition would be. But what would be some risks that would keep you up at night in regards to the strength of the economy?
Well, some of them are geopolitical, and those are probably the easiest to understand. You could have wider war in the Middle East. The news in the last few days does not sound very promising for those that think that is well contained. You've got ongoing war in Ukraine, and as people predicted that was going to be long and drawn out, but that also has, you've got the Ukrainians going across the Russian border. And again, it sounds like a wider war is a possibility. So I think those sound like dangerous situations if those developments occur relatively rapidly. You've got other geopolitical risks, certainly with China and their intent with Taiwan, for instance, and then you got sort of I guess technology interfacing with the financial system, and that makes one wonder if you could have financial market upset as we did in March of 2023 with SVB failure. So I don't think those risks are particularly high right now, but those are the kinds of things that tend to be hidden from sight until they're not.
Okay, well, we'll follow up on those risks later on. Thank you very much, Jim. I don't want to keep you too long. You've been very generous with your time already. Before we go, maybe give us one story, your most memorable experience that you can share with us while you were at the St. Louis Fed.
Yeah, I don't know. It was the day I almost killed Alan Greenspan. I think that's probably the
Would you care to elaborate on that?
I actually went to the FOMC meeting as a staff person, not as president, and I had not been to meetings previous to that. I don't think it was either the first or second time I'd gone there, and I didn't really know where to sit. The staff sits around the outside, so I sat in a chair and I put my bag down, and it was kind of a big bag, and I didn't realize that the chair, and Greenspan was relatively old even then, and he walked out, he liked to come into the meeting exactly at a certain time. And so he opens the door, he comes in, he trips on my bag. I imagine this headline, Stafford kills Greenspan, global markets tank, you know. But I don't. He recovered. He recovered, and he walked around to his seat. And it was a non-event. I don't even think people in the room really knew it. But
Yeah,
for
that
me,
another way to ease monetary policy to to off the chair. All right, we appreciate you coming on the show today, Jim. Anywhere we can follow you, any social media links or books or works that we can go to read you?
I think the dean here, I'm dean of the business school here at Purdue, the Mitch Daniel School of Business. We're on LinkedIn, so you can probably follow me there. That's probably the easiest.
All right.
We've got other news that we can report about our school.
All right. We'll put the link down below. Thank you very much, Jim. Appreciate it.
All right. Thanks very much.
Thank you for watching. Don't forget to like and subscribe.